some possible tips on how to place our stops when we're trading major events like policy decisions or key economic data points. Obviously, every trader out there is different, right? So I'm going to explain the way that I like to do it and the way that works for me, but that type of setup might not be the best setup for every trader out there. Obviously, there's going to be many different takes on what the best way to do it. This is simply the way that I prefer to do it and the way that it works for me. So the very first thing that I like to do when it comes to trading these types of key events is obviously recognizing that there is going to be higher volatility, at least a much higher probability of much higher volatility than we used to. And whenever I anticipate a surge in volatility, or at least spikes in volatility, I normally like to trade with wider stops than I would normally like to trade with. But there's actually a few key frameworks that I use to choose stops. That means that I'm normally choosing pretty much the same ones, even though in a very volatile situation, I might expand that range ever so slightly. For me, I don't really focus on things like risk to reward when I'm trying to define and limit risk. If I'm trading an event like something like the FMC, I only want to trade it when I have a big edge in the markets. If I know that I have an edge to trade with, I'll trade it. If I don't, i.e. if the markets doesn't give me the scenario that I planned for, or at least a scenario that I prepared for, if I don't get that very high probability scenario, I'm happy just to stay out of the volatility and miss out on that move. Because if I don't get that ideal outcome, then it drastically reduces the edge in the markets, and that always makes me a little bit uncomfortable to trade. So with that in mind, if I know that I have a good edge in the markets, then for me, something like risk reward is not as important compared to just getting the trade direction right. If I know that my analysis and my trade direction is correct, it means that I should win a lot more of those types of trades than I lose. And that for me means that I'm less concerned about placing my stop to make my risk reward make sense. I'm more focused on placing my stop based on where I think I'm getting the trade wrong, right? So instead of placing a stop where I think, okay, if I place it here, I might get a good, risk to reward based on the next key level, I don't really focus on that. I just focus on the direction, and then obviously, making sure that if I do enter it, I'm entering it on the right reasons, for the right reasons in the right direction. And that means that more often than not, the trade will move in that correct direction. As opposed to trading something that's purely mechanical, where you definitely need a positive risk reward. If you're trading it this way, you don't really need a positive risk reward. And oftentimes, if you take a look at where I place my stops and where I get out, oftentimes my first or second entry that I take profit at won't have a positive risk reward. I'll only start getting a positive risk reward on maybe the third unit of a potential trade. But I'm okay with that because, again, my hit ratio is a lot higher with this way of trading it. So the first thing that I like to do based on that is just widen my stops. But again, my focus for stops isn't on getting it as wide as I can. It's basically placing it where I think I'm wrong if the trade goes against me. Where do I think the market needs to go to tell me, hey, you're wrong on the direction of this trade? So the very first thing that I use for that is just using those key psychological swing points, right? Or key technical swing points. If we just go to a lower time frame and look at these two examples for the FMC in May and FMC in March, I would also encourage you to go back to the videos that we did at that time because we traded both of these events. Let me just quickly hide the Aussie dollar here for a second. We traded both of these events, and I'm sure we did detailed videos on the entries and also showed where we exited these trades. So it might be worth just going back a little bit and go and reviewing those trades for some tips as well. But the basic idea, or the broad idea, is, let's say I'm using the May trade as an example. I'm not going to place or use any of these swing points for a stop loss placement, because for me, there's only one real swing that I need to worry about. So keep in mind, we don't know that all of this has happened yet, right? So if we take a look and assume that we're going into the meeting, which means that we only would have had that information. If I'm looking at this structure, for me, the bare minimum where I need to place my stop is above this swing over here, because I would need the markets to break above that to really tell me that, hey, I'm wrong in the direction of where this trade is supposed to go, where I thought it was going to go based on that outcome. So key swing points is definitely the first key that I would looking at, first element that I would look at. The other one is just using those key those key pivot points, right? Pivots is such a helpful indicator, something that I always use in the videos as well. When we talk about possible levels, that's definitely something to consider. So let's say that you are considering a particular level, and let's just say, for argument's sake, that we had. I'm not going to go back to the pivots this far back. It's just so far back. But if let's just say, for argument's sake, we have the R1 pivot somewhere over here, and let's just say we have the R2 somewhere up here. If I know I have my key swing at this level, but I have the R2 pivot just slightly above that, I'll choose to anchor my stop rather above the R2, because it just gives me that extra additional level of resistance, if that makes sense. So the first one is just key swing points. The second one is using basic things like pivot points. The other one that I like to always incorporate, as you know, is psychological levels. So on this example, once again, we've got the swing, and again, let's just say that we had an R2 pivot somewhere up here. Where we can anchor from. We also have the 104 psychological level. So that gives us one more barrier that we have to deal with, or that the price needs to deal with, to tell us that, hey, okay, you're wrong with this trade, or where the direction is going. So key swing points, pivot points, key psychological levels. And the other one that I like to use is the implied volatility levels that you guys see us use. Now, what I've been trying to do over the past couple of weeks is give you guys these levels in the daily video. So obviously, I know not everybody will have access to implied volatility data. So this information that we have in the model, what I try to do with these daily high and low levels, I try to update that in the terminal, or in the on the charts for you guys. So when we do the videos, like the opening videos, you guys have those ranges that you can play with. But this is definitely a key one that I use for my own, not only targets, but also stop losses. So let's use the example that we just went through with all of those levels. Do I have some major swing points that I can anchor from? When it comes to the dollar in a session like today, we don't, because we've got nothing on the left-hand side to work with. We don't have any type of spike highs like we had with that May decision. I think even with the March decision, there was some key highs that we could have used. But in this case, there's nothing, because price right now is the highest we've been in going back 20 years. So there's a whole lot of nothingness on the left-hand side. So key swing points isn't really going to do me any good right now. The next one is pivot points. That's definitely one we can look at. So we've got the R1 over here, but let's just add in the R2 and maybe even the R3. Would I like to use the R3? I mean, that's a little bit of a ways away. 107.50 is quite a wide stop on something like this. I think the R2 would be slightly better. What I like about the R2 is we're marrying up with a psychological level, which is the 106.50. We've got the R2. We also have the implied volatility high for the day. So that's a really, really good zone to look at. The one thing just to keep in mind is that if we take a look at the implied volatility high and low, remember, this basically tells me that from the open, this move to the upside would be a 1 sigma move, and this one to the downside would be a 1 sigma move. So if I really wanted to protect myself against rapid, much higher volatility, then doing it 2 sigma away, at least 2 sigma, might be a better option. So in a trade like this, even though the R2, the 106.50, the implied volatility high, all of them do pose some tough resistance that the price would need to crack. If we really wanted to protect the trade against a very heightened volatility, then probably above that R3 now, as well as that 107.50, looks like the safest option. Now, again, whether you place it there or whether you place it just above that level, there isn't much difference between those two areas if you have the right type of risk. Risk setup, the right type of position sizing. So for me, I prefer to rather take the wider one normally, because I want to know where I'm wrong. And when it comes to a trade like this, though, if we manage to break and close above the R2, it's probably going to go higher. The risk is, though, that sometimes, and this is really a very important point, even with the perfect stop loss setup, the perfect process, like let's say you design one that you like to use, even with all of that being perfect, the markets can still surprise us, right? The markets can still, spike up all the way, into your level like that. And then the next second, boom, pushes lower, goes the other direction. Those types of trades where the market takes you out, even when you've anchored your stop safely, it's going to happen. It's happened many, many, many times with me before. It's it's something that you'll need to deal with. You won't be able to survive all of them, which is important to keep in mind. So the other thing that I just wanted to talk about, apart from stop loss placement, is your profit taking and your trade management is equally important for me when you're trading these types of events. What you want to do is, if you have your trade direction for the trade, so obviously we are preferring to trade a dovish reaction with a sell trade on the dollar. If that's your preferred trade, you need to first ask yourself, am I trading in line with the fundamental bias or against it? If I'm trading in line with it, I might be able to give my profits a little bit of, I might be able to stretch my profits a little bit. I might be able to press that short or press that long a little bit higher, let it run a little bit longer if I'm trading in line with a strong fundamental bias. But in the case like today, where we're trading against the strong fundamental bias, we were basically looking to short the dollar against a very strong bull run. I'm going to be surgical when it comes to taking profit, which means that I'm not going to play with the markets. I'm not going to allow the markets to give me a fair amount of profit and then allow it to take it from me. I'm going to be like surgical in taking profit with those trades. If I reach a key level to the downside, either a swing point or a pivot or a psychological level or an implied volatility level, I'm going to take my chances to take profit as soon as possible. And after I've taken my first profit, I move my stop to break even. Now, there's going to be many different takes when it comes to that type of style. There's a lot of research that says that if you move to profit too early, you're risking getting out before you make more money. Again, for me, this is the way that I like to do it. It's the way that works for me. There's going to be research that shows, against that, research that's in favor for it. It's the way that I like to trade. I like getting out of risk as soon as possible. So profit taking and trade management is just as important as the stop loss placement. So I like to use those key levels. So for today, for example, we've got a nice confluence of zones here because we've got the psychological 104, the psychological 103, we've got the S2 pivot, the S3 pivot, and we've got a 2 sigma and a 3 sigma move. So these two levels will be just key profit-taking levels for me to choose when I'm trying to take profit. And you can use that same methodology for stop loss placement as well. It's using all of those levels to your advantage to place it. But I think in a nutshell, for me, the biggest one is that I'm more concerned about placing my stop where I know I'm wrong with the trade, as opposed to trying to get it like as tight as possible in terms of risk to reward. For me, the focus is more about getting the trade direction right, as opposed to getting the risk to reward right. If you, in my take, at least in my opinion, if you make sure that you get the trade direction right more often, you don't have to be as stringent when it comes to risk to reward. Always risk management focused, but risk to reward not really a big focus for me when it comes to these types of things. So hope that's been helpful. As always, any other questions, don't hesitate to let us know.